Unleashing Capital. This is Policy Exchange's first discussion of the year, so thank you all very much for coming. I'm very glad we had such a great turnout. As you can probably tell, there's someone conspicuously missing from the panel at the moment, but it is hoped that we can beam him in virtually very, very soon. But I thought, in the interest of time and the interest of everyone's sake, we would start the discussion. So I'm very, very glad to have here a very, very distinguished panel who, in many respects, don't need an introduction, but I'll start with an introduction nonetheless. Lord Jim O'Neill, Baron O'Neill of Gatley, former commercial secretary to the Treasury, and now chair of Northern Gritstone, a fantastic university accelerator in the north of England. Kitty Ussher, former economic secretary to the Treasury, and now chief economist of the Institute of Directors. And to my right, Mike Eakins, chief investment officer of Phoenix Group. And I'm very, very glad that we've been able to assemble this panel discussion, framed in part by Policy Exchange's paper published last year, Unleashing Capital, looking at institutional barriers to investment in the United Kingdom. And in the context of 2023 and the somewhat perilous economic times we find ourselves in, how we can get investment going again in the UK economy, and how we can unlock the immense amounts of financial capital that exist in UK markets. So to maybe begin the discussion, I'll sort of set the scene a bit in the UK context. So the two institutional pieces of institutional sectors I really looked at in the piece were insurance and pensions. And in both counts, even though the UK has the second largest set of pension assets in the world, and even though our insurance industry is one of the largest in the world, our pensions and our insurers tend to underinvest in things like venture capital, in infrastructure, in other productive assets that can make the economy grow. So the work I did, and the work sponsored by Phoenix Group, really looked at these questions and looked at how we can unlock institutional capital in the UK. And some of the points we came up with were things like better consolidation of the local government pension scheme, ensuring more consolidation in the defined contribution pension market, looking at real and substantial reforms to the Solvency II framework, which prevents insurers from investing in the range of assets that can drive growth in the economy. And then there was also a devolution piece, which is why I included levelling up in the title of this event. The UK is, as probably many of you know, is the only G7 country that doesn't have a uniform set of regional governments. Its local governments are relatively less powerful, have significantly less fiscal autonomy than regional governments in other jurisdictions. And all of this means that in many respects, it is very difficult to unlock institutional capital in the UK context. So with that scene setting in mind, I think I'll turn to Lord O'Neill first. If you could set the scene, if you could speak to us about what Northern Gritstone is doing and the challenges you've faced in accessing capital.
Okay, thank you very much, Connor. It's a pleasure to be here. I shall do that, including trying to reflect on what you just said about your paper, and congratulations for releasing it. As maybe some of you know, maybe quite a few, I have various interests in all of this, especially on the latter part. Coincidentally today, I've not had a chance to see what the Secretary of State for Levelling Up said, but myself and colleagues at the Northern Powerhouse Partnership were rather hopeful he was going to be quite ambitious, consistent with Michael's spirit about devolution. So I hope that is the case, and because I'm probably more immersed in that part of the journey than other aspects. And Gritstone sits very closely in the front of that, or in line with that. Let me try to summarise it briefly. So we have 16 universities in the UK that are frequently recognised in the world's top 100, more than 4 times our share of global GDP. At least half of them are in really low productivity parts of the country, and as brilliant as they all are, they don't really do much for the never-ending seeming decline of the relative performance of those places. Gritstone is designed to try and attract private sector capital. It's not a fund, because it wants to be patient capital. It's a company, which adds to our dilemma of how we attract institutional money, but we only want people to be with us that get it. and we are trying to unleash the brilliance of those universities to create very successful businesses that, amongst other things, will create value-added paying jobs for places in the areas where they are. In essence, that's what Gritstone's all about. Given I spent far too much of my life interesting. I was trying to think of a witty thing to say.
They're setting the dogs on you.
There you go. I haven't said anything wrong about Michael either yet, so it can't be one of Michael's dogs. Given that I spent over 30 years 24/7 in finance, 2/3 of which with the one and only Goldman Sachs, I obviously have a long history in that, and being the non-exec chair of Gritstone as it tried to raise money to come into existence, which we did last May, let's just say it is fascinating to witness the challenges of raising proper growth-facing investments. And I could offer plenty more about all of that, but I think I should probably not for now.
Great, thank you. Kitty.
Well, thank you very much, Connor. We may not have our minister, but we have at least 3 former ministers in the room, as far as I can work out. Lovely to be here with Ruth Kelly, another former economic secretary too. So my cunning plan had been to listen to the minister and then respond. So I've been rapidly scribbling notes, and I'll try and add some value. I presume he will be responding to us. Is that right?
One can only.
Okay, but great to be here. And I wanted to start by congratulating you, Connor, for a really extraordinary piece of work on the most unbelievably technical subject. It is really unusual for a Westminster think tank to really get into the granularity of financial services reform, but you tackled it with gusto, and you had an almost immediate impact, as far as I can work out, because several of your recommendations are already government policy. So either you are, the person to staple oneself to for the foreseeable future, or you did that very cunning trick of smelling which way the wind was going. We presume, Minister, that you'll be responding to us. Is that right? Rather than us responding to you. It's very good to see you. Shall I carry on? Yeah.
Apologies for lateness.
Shall I just carry on? Yeah. Yes. Okay. So either, or you've done the wonderful thing of smelling which way the wind was going, and then recommending exactly that. So if the essay question is, how do we release productive capital? I remember doing a project on this probably about 10 years ago, going around various chief investment officers and all the big funds that we all know of, and the constant message was reform Solvency II, and that was a decade ago. So this is quite an interesting time to be having this debate, because it may be that now the government has done the welcome thing of reforming Solvency II, that it's quite hard to disentangle what the remaining problems will be. So perhaps I can just chuck a few things into the mix. I should say I'm speaking in a personal capacity because I also sit on the board of an LGPS pension pooling company, but I have learnt something from there that perhaps would be useful. The first is that don't forget the demand side, I think. So government policy in this area goes broader than financial services policy. Because if you're a company considering whether to raise funds in order to pursue your next most important investment, then you're much less likely to do so if you feel that the external environment means that the risk outweighs the potential reward. And then discussions about the Macmillan gap or any other sort of difficulty in raising finance are purely kind of academic, because you're not seeking the finance in the first place. So don't forget the investment incentives, don't forget the super deductions, don't forget what it is that's actually holding back firms from investing in anything, whether it's taking on a new member of staff, workplace skills, anything that is fundamentally a risk-reward judgment. Certainly at the moment, with the macroeconomy, looking pretty dodgy to to be, quite positive about it, and sentiment as low as it kind of possibly can be, although recently, hopefully it's slightly improved. There won't be as much demand for finance as there would be in a different situation. And government has a massive role there. Second point is around your really welcome proposal around consolidation, particularly of local authority and other public sector funds. I think, there's so much fragmentation that has to be one of the ways forward. And I hope the Minister will talk to his colleagues in the Department for Levelling Up about the imminent guidance to local authority DB pension pooling organisations, to sort of really encourage the move in that direction. But let's be really clear about what consolidation does. It professionalises the sector, it gets economies of scale, it drives down cost, it brings greater expertise into the sort of management of the funds insofar as they relate to the ultimate beneficiaries, but it may not change the asset allocations. Yeah. So, you would hope that with greater expertise, there'll be a more efficient asset allocation. But if fundamentally they only want to put 5% into, infrastructure, then that's not going to change just by consolidating. And it, to then jump to and it may not necessarily mean that we'll get more funds in different parts of the country, because that's fundamentally a risk judgment. And sort of finally, to your point on levelling up, you are urging greater regional devolution, but certainly in terms of how local authority DB pension funds are currently constituted, they currently are organised on a regional basis. And that should lead to greater incentives insofar as they go into private markets to put it into their own package, if not in every local authority. So there's a certain clarity of thought there. If something was risky, is risky now, it doesn't make the risk go away by changing the structure. So that's probably it for the moment. I've got some sort of other queries about the Edinburgh reforms, but probably best to respond to the Minister for those. So thank you.
Thank you. Shall I go to the Minister next, and then Mike?
Sure.
Perfect. Well, look, thank you very much indeed to Policy Exchange for having me in this really rather smart venue. But think tanks have come up a little bit in recent years, and my apologies for being late. I was exercising my democratic duty and making sure that we got the economic crime bill on the statute book, which is also important to how we make sure that markets operate cleanly and fairly. So. No real apologies for that. This is a really useful contribution to a really, really important debate. In a market-based economy, the free flow of capital to productive uses to both deliver a return on the owners of that capital, but also to deliver positive outcomes to society is very important. It's something that we cannot make the case for enough again. This is a super young audience, but it's really important that we can make that positive connection, because too many people don't see that. And if we don't manage to make the intellectual arguments for what we're doing, then ultimately we're not going to be able to make the practical arguments either. So again, thank you to Policy Exchange for stepping into that breach. Now, how we unleash capital, which is central to this government, and I'm quite confident any government's objectives, is a really important topic. There are none of the big issues that we face as modern values-based Western democracies are things that can be solved either by the state or by private capital alone. We have to work, as we did and we saw in the pandemic, we have to work hand in hand. And that does require, because of the scale of the challenges, because we're living longer, because people's aspirations increase in a world where an online retailer can pop your groceries through your letterbox in a 5-minute time slot, where we've got people who want to operate within highest quality public services and the most robust and resilient public infrastructures, we're going to need capital. And so we have to find ways of making that be unleashed, as this report says, and removing points of friction. The role of the state in this is not to direct capital, perish that thought, things would rapidly end up in a bad place. But the role of the state is to create the environment, the macro, I think Kitty may have talked about this, the macroeconomic stability, the certainty of regulatory framework, the respect for institutions, but also to eliminate frictions, points of friction, often in the regulatory regime, of which Solvency II is an excellent example. We know that we're embarked on one of the greatest adventures in the demand curve of investing, the transition to a whole new clean energy system. But there were imperfections in Solvency II as it was written in the previous rule book that simply didn't allow for the construction phase of projects, that forced everything into a naive view of an investment proposition that really started to resemble something almost akin to a gilt. Gilt has very many virtues, buy as many as you can, but it won't necessarily be the answer to how we invest and drive performance on the back of the clean energy transition. So I was very pleased that as one of the initiatives that the Chancellor's announced in the short tenure of this administration, Solvency II is one of those measures at the heart. It's not by any means all, and perhaps rather than make my remarks go on for too long, we can talk about some others, how we do indeed give pension funds, one other big pool of capital. If Mike represents insurance companies, then the other is the ever-growing pool of particularly defined contribution pension schemes. And there's some things that we can do to allow some of that productive capital to be better deployed as well. We've eliminated some of the artificial parameters around charges so that you will all get a better performance from your pension by being able to invest in a slightly more diverse class of assets that offers you the challenge of greater performance. Because one of the, it's always us that pay the price, but one of the challenges of a financial services system that's not quite working, that's not quite optimizing the allocation of capital, is actually that it's the participants and beneficiaries in the system that don't get to fully take advantage of that. So the government is very focused on this whole project of how you unleash capital. Of course, it's not just on the supply or demand side. It's how you bring forward projects. It's how you work with local communities as well to make sure that those are fully investable. But certainly, so far as the financial regulatory regime and our attitude and appetite for risk, without which a financial system can't deliver a productive return, then this is absolutely, the recommendations here are front and square with how we're thinking about things. The Chancellor announced the Edinburgh reform, so the programme of work that I've been set for 2023 is to get the new Financial Services and Markets Bill on the statute book. That's the sorting hat that allocates some of the powers that were previously exercised in Brussels at the different regulatory levels in the United Kingdom, to go forward and deliver that package of 30 measures and the Edinburgh reforms, including Solvency II, but also working with my colleagues to see what we can do in the pension sector to start unleashing that pot of capital as well. And then, of course, because our work is never done, to continue to push forward with further reforms, as well as some of the broader agendas within my wider portfolio.
And on the note about investing and Solvency II and appetite for risk, Mike Eakins, Chief Investment Officer at Phoenix.
Yes, thank you very much, Conor, and thank you for the opportunity to be here. Phoenix are absolutely delighted to work with the Policy Exchange on this really, really important report and thought leadership piece of work. So who are Phoenix? Well, today, Phoenix, we are the UK's largest long-term savings and retirement provider. We manage about £270 billion on behalf of 13 million customers, predominantly in the UK. That means we manage the pension provision and the retirement income for approximately 1 in 4 adults in the UK. We are a commercial organisation. We're FTSE 60, so we need to make money for our customers, for our shareholders, and for our colleagues. But fundamentally, we are a purpose-driven organisation. And that purpose is what drives us every single day. A purpose to provide our customers with a life of possibilities into and during retirement into later life. And a key vector for that is how we invest their assets. Because we need to remember, we can talk about £270 billion of assets. They're not my assets. There are 13 million customers' assets. And how we invest them, we really focus on a number of key areas. Sustainability is absolutely key. We absolutely want to be the engine that develops the green technology. And we can only do that with the right regulatory environment. For too long, it's been our investment thesis that there's been too much capital invested in London and the South East. Our 13 million customers are not all concentrated in London and the South East. We map them out. They're spread out over England, Wales, Northern Ireland and Scotland. And it's really important for our customers that we invest their assets in a regionally diversified manner that makes impact for them in terms of investment returns and local economies. We're pretty unique in that we invest over the very long term. So when we decide to invest in an asset, we don't think about what's that asset going to return next week, next month, next year, not even next decade. We have a multi-decade approach to our investment horizon. And that really affords us to be able to be at the source and center of productive financing. We're proud to have made some small, modest investments in asset classes like VC, but we'd love to do more of that. And with the right regulatory environment, Phoenix, the UK's largest long-term savings and retirement provider, purpose-driven, we have said with the right regulatory environment, we stand ready to invest 30 to 50 billion pounds of assets over the next 3 to 5 years in productive finance. Now, we think the size of the prize is massive for our customers, for our shareholders, and for our colleagues. We even think it's bigger for broader society. If you take a step back, and Colin, I know your report alludes to it, but it's a really important statistic which resonates with us. Today, the UK, in terms of pension assets, has the second largest pension assets in the world. Only the US have more pension assets than us. In the UK, there's approximately £3.4 trillion of pension assets. And to date, well, certainly some point last year, only 7% of that £3.4 trillion was invested in what we would classify as productive assets. What do we mean by productive assets? We mean stuff like VCs, investing in universities alongside Lord O'Neill, real estate, infrastructure, green technology, those assets that people can really touch, feel, but also deliver a significant investment return. And the size of the prize is this. If we look across the G7 nations and we look at those pension assets, the average allocation across G7 nations to so-called productive finance assets is 19%. The UK today is at 7%. So the size of the prize in terms of what we can deliver in terms of investment returns to our customers, delivering on that purpose of providing them with a life of possibilities to our shareholders and to our colleagues is significant. But it goes beyond that. It goes beyond our customers, our shareholders and our colleagues. It is into broader society. We want to invest in over the long term in a way which delivers those investment returns to our customers, delivers on the green agenda, but in a way which is beneficial to the economy at large. And it is for those reasons that we absolutely welcome the regulatory reforms that are being put through. These regulatory reforms are really, really important. They absolutely must have and still have consumer protection at its core. But having objectives, regulatory objectives associated with growth and competitiveness are absolutely key because we operate in a global marketplace. And as we see, foreign investors will come in and take some of our assets from under our nose, assets that pension funds and insurance companies should be invested in. And so it's for that reason that we absolutely welcome the report by the Policy Exchange and welcome the swathe of regulatory reforms that are coming through the Solvency II reforms and the Edinburgh reforms.
Thank you. So I'm gonna try to encapsulate all that in a question for the panel, which is that we've mentioned regulatory reforms, but I think sort of a shadow that sort of haunts all the answers and everything we've discussed is the fact that it isn't just about the regulation. It's about changing the culture of investment in the UK towards productive assets and towards these kinds of investments. And I guess maybe the question I have is, one of the things we know is that UK pension funds, UK insurers, Phoenix excluded, can sometimes take very conservative approaches to these kinds of assets. And as well, the regulators themselves can take very conservative approaches to regulating this kind of investment. So I suppose, Minister, if I can start with you, and then I'll open it up to the panel. Yes, we can change the regulation, but how does the Treasury, how do we ensure that there's an embedded cultural change after these reforms go through?
Yeah, well, you're quite right on the objective. We do need to get a reset in the balance between the objective we seek called growth and international competitiveness. And we've written that in the Financial Services and Markets Bill. That's written in to the statute now of the regulators. So they're independent operationally, but it's for Parliament, quite rightly, to lay down the criteria that they have to try and balance between. So that's one aspect. Another aspect is greater transparency around the operations of those regulators, so they can be held to account very widely by all of their stakeholders, and increase the pace at which they act, because it's a competitive world, and if you are in the business of trying to deploy risk capital, then time itself is one of your big opportunity costs and challenges. And then I think we need more of public debate, needing more of topics like this, so that we can reconnect the deployment of capital with the lived experience of ordinary people. I always say I'm supposedly the city minister, but I'm very happy to be the city minister. But the city I have in mind is the city of Middlesbrough. And the person that I have in mind that I want to deliver for is a mid-terrace homeowner, or someone who lives in a mid-terrace in Middlesbrough. Because if we can't make that connection, then we're going to find it very, very hard to drive risk into the financial system, because everyone's going to look at this as something that simply externalizes all of its problems and doesn't deliver benefits for society itself. If we can make that debate a little bit upstream, that all of us take a much more even-handed approach to those who deploy capital, those who invest that, then we've got more chance of making that a more balanced debate, and then we can try and get proper, sensible, well-measured, well-mitigated, transparently communicated, but nevertheless, risk in the financial system, without which there isn't, of course, any reward.
Thank you. Lord O'Neill, can I go to you?
Thank you. So, a couple of things. One sort of, I don't know what the phrase is, sobering or reality check macro thing is, we are a low savings country, so one real goal, which is not really what you're asking, but I think it's important to say, is that we have to consider trying to raise the national savings rate, and then there would be even more stuff to go around into everything. And one would assume that might make it easier to invest more of that unproductive stuff. And with it, and I'm going to touch on this more, so I'll say it now. I led a review into startup capital recently. Nothing like as influential in the policies already done by yours, but it was not least because for the opposition. And another important dilemma of this is this never-ending complaint that you hear a lot out of the VC world, and I'm pretty immersed in the VC world, that all this money is coming from all these places around the world. Well, if you have a low savings rate, and you have a current account deficit, that's kind of what happens. And it's coming from places that have a lot of excess capital. So in that sense, stuff arrives, but it'd be nice, I think, to have more. And at the core of many ways I could really answer you to be relatively brief. We have to change the risk reward. It's pretty straightforward. From my way of experiencing close to 40 years of finance, 30 odd years of it deeply immersed in it, that the markets play by the sort of way the system operates. And if you really want to change it, you've got to change the calculation going on about the risk versus reward. And in that review that we've published, there's a couple of kind of pretty basic things you can do. And notwithstanding Andrew's really important point, and I fully respect that. You've got to be really careful about trying to direct capital. However, because of the fiasco of 2008 and past errors, the government, the taxpayer, owns the British Business Bank, and it's quite obvious, not least because through its allocation to BPC, it's actually the biggest investor in venture capital in the country. It could easily have a lot more aspiration to play a more active role in this, including making life a lot easier for the pension funds. One of our specific proposals is they could be mandated or choose, I think, actually, I don't know, to create a sort of pooled vehicle, let's call it, for those of you familiar with finance, a modern version of a fund of fund about existing VC funds that would make life easier for pension funds, particularly those smaller ones that have no resources. As an aside, as I sort of hinted at as a slightly sarcastic joke at the end of my last comments, it's not entirely clear to me that local authority pension funds are more risk averse on this stuff than all the other pension funds, and certainly from our experience at Gritstone, that is not the case. So you want to be really careful how far you make that presumption. Some of them actually have a much more genuine long-term vision about the kind of things they will support, from my experience. But the way you change it, if you really want to change it, is to change the risk-reward incentives and to bring Joe Public into it. One of our other recommendations, some of us chatted a bit earlier, is you might call it a modern version of Call SID, where you actually have for those of us around pension age and you think about these things, you have to tick certain boxes. You know, why not have one for do you want your fund to invest in infrastructure or whatever? Or getting rid of the Glazers at Manchester United. Or, you know, useful things in life like that. I could go on.
Thanks. I think I agree with everything you've said. Let me see if I can try and add. No comment. As a Burnley fan, we don't need to worry about these piffling. 20 years ago, I was special advisor to Patricia Hewitt, who was then Secretary of State for Trade and Industry, and this conversation has reminded me of a classic bit of New Labour triangulation in a line we wrote in a speech for her, she wrote, of course, to Labour Party conference in, I don't know when, probably about 2002, and it went something like this. Before I launched into it, remember the audience, Labour Party conference. It went like this: we, the people, own British business through our pension funds. Okay. Now I think this was a sort of progressive sort of moment of kind of Damascus-like conversion. I think at that time. I mention it because it's almost word for word what you just said about how we sort of own British business, but also just to say quite how long policymakers have been grappling with how to sort of channel this capital that we all own into the sort of society's priorities, I guess. And this is a sort of way to get into the culture question, which is a really, really good question. And we've had some discussion of this already. I think there's a sort of some kind of market failure in the way that people understand their own pension funds, because if the question is asked in the right way, I think they'd have some quite strong views about how it's invested, but it's typically asked in a way about what's your risk appetite, and so they end up going, oh well, my pension is really important, I've got a very low risk appetite, so I'm going to tick the very low risk box, and then they end up not getting the returns that they should have, given they've got so many decades to play with. And so probably the question needs to be, given your risk appetite, would you like it invested in your community or in ESG or this or that? And so perhaps there's a role for government, if that is a market failure, because they probably do have a view, that there's a role for government for, dare I say it, perhaps more regulation to require that conversation to take place in some way, so that you can align the incentives of the people and society and asset managers. The other thing is, and this seems to be a market failure as well, is the retail market for even kind of corporate bonds and relatively low risk assets is very badly developed in Britain. You can go and do some kind of very high risk crowdsource, or might be high risk crowdsource thing, but you can't actually go and buy a bond in Shell very easily. Or if a pretty blue chip organisation was trying to do something pretty standard, as a member of the public, it would be quite hard to invest straight in that. Maybe the solution is the funds of funds, or it may be that we actually need to develop a direct retail market as well. But I think both of those things would help sort of address the culture issue a little bit if you've got a real stake in it. Just while we're on market failures, I disagree with you, whilst respecting you, Minister, around reforming the objectives of regulators on the face of the bill. And that's because I think I have a slightly different understanding of what regulation is for. I think regulation is there to correct the market failure of asymmetry of information between consumer and financial services firm. So it's there to protect the consumer. And I think the way it's currently written is to protect the consumer where possible through competition, because there's a massive presumption that competition works for the consumer as well in most cases. I worry if you put growth up there that it will lead to decisions that might favour individual institutions, but not necessarily the macro, the vibrancy and dynamism of the macroeconomy as a whole. I know I'm not going to persuade you to change your mind, but in the spirit of a think tank style discussion, I throw that out there.
This is an exchange, after all.
It is an exchange.
And Mike.
Well, Conor, we'd say two things in response to that. One is, and it's an important aspect and outcome of your report, which is this concept of devolving planning power, for want of a better expression, to local authorities and mayoral authorities. We think that's really, really important. As investors in local authorities and with mayoral authorities, we take a high degree of comfort when local authorities and mayoral authorities have the strategic agenda for setting their own planning power. We think that's a real positive. Now, how does that link to sort of changing the risk culture? One of the fundamental gaps in the long-term savings and pensions market is, engaging the customer. Lord O'Neill's absolutely right. People need to be saving more for their retirement. People are living longer, and the state support will not be there, so they have to have their own provision. So it comes back to this whole concept of financial inclusion. How do we make the key aspects and outcomes of this report relevant to those key people that the Minister is focused on? I think you said in Hull Minister or Middlesbrough. Mid-Terrace and Middlesbrough, absolutely. How do we make it relevant to them? Well, we make it relevant to them by investing in real assets on a regionally diversified manner. And I'll give you one very brief example. Today in the UK, I think most people will agree, there is a chronic housing crisis. 2 million families living in either unsuitable, unaffordable, or unsecure accommodation. We need to build more houses. Phoenix, the UK's largest long-term savings and retirement provider, we've invested close to £2 billion in social and affordable housing. Now, we want to do more in that respect. One of the areas we were prevented of investing is investing in housing associations who haven't yet built their houses. So a key aspect of the regulatory reform that we're seeing coming through, again with consumer protection at its core, is we will now be able to provide capital to housing associations, local authorities, to help them in the construction phase of building those housing stock. That's really key because it allows us to get engaged earlier. But that's an example of a real asset, a tangible asset that people, our 13 million customers, can see those assets being built, delivering them a positive return, but having a long-term societal benefit as well.
Thank you. I'm going to open it up to questions from the floor. So if you have any questions, please raise your hand. That gentleman over there, and then that gentleman here, and we'll do a few, and then because we are a bit pressed for time. Yeah.
Don't need a microphone.
Your name and organization, please.
Thank you very much. I can follow you on the regulatory...
Sorry, name and organization first.
Rudy Bogni. I'll give you one organization, Lightrock. And if I can follow you very well on the regulatory aspect, I can follow you on the consolidation aspect. Where I don't follow you is why you assume that this new volume of investments would necessarily go to the UK economy.
Yeah.
And I can give you an example. I've been involved for the past 20 years with the investment of German, Swedish, other Scandinavian pension funds in private equity, in infrastructure. I'm following them now in investing in impact field. And I can tell you, most of the money doesn't get involved within the country of the pension funds. So why do you make this logical jump that funds will come into the UK economy? Thank you.
Yeah.
Sorry, just the mic. I can
Thank you. Mark from the Centre for Inequality and Levelling Up. I'm not exactly aware of all these, knowledgeable about, finance and financial discussions, but I understand that one of the primary challenges of levelling up is investment over the long term. I know, for instance, Mike, you were talking about that, investments over 10, 20 years. And I also know sometimes maybe one of the issues with the financial world is, and in some circumstances, an aversion towards long-term investments, because you need to, avoid risk. You need to make sure that investments are successful for your investors in general. So maybe perhaps investments more in the short term. So how can we make sure, I know you were talking about that, the change in culture, but how can we make sure that the financial world in the UK can invest over the long term, over 10, 20, 30 years, to make sure that levelling up is a success? Thank you.
So if I may, I'll answer the first question, then I'll open the second question up to everyone. So yes, I think it's a really good question. So I can tell you I'm a Canadian, and Canada obviously has some of the largest pension funds in the world. And the Canadian pension funds will tell you that actually they've outgrown the Canadian market. So they're now so large that they have to diversify outside of Canada. But they're also so large that even with relatively small, like 5% allocations to these kinds of assets in Canada, that's a substantial amount of assets. And I think the point of this paper is to show the extent to which, in many respects, institutional capital located in the UK isn't even really in the game to the same extent as in other jurisdictions. And obviously, as defined contribution pensions in this country mature, as they enter the size of funds that you get in Australia, for example, you are going to see relative diversification away from the UK market. But I think the point here is that the funds in the UK context are just not even playing on the same field as some of these other large institutional investors from other jurisdictions that, quite frankly, are here diversifying in the UK because they've outgrown their home markets. So that would be my answer to that question. And then on the second question, on how we encourage long-term perspectives, shall we go Minister, Lord O'Neill, and then Mike?
Yeah, look, I mean, a lot of this is about people's natural sort of, almost path of least resistance. If you are looking at long-term money, and you've got an environment that allows you to perhaps not have to constantly mark to market, you've removed, get technical, but you remove ratings cliffs that over a long-term project, you could trip that cliff once. That's a feature of the current regulatory system that we're trying to remove. But we should hear from Mike, but if you are looking at a liability, this is an impossibly young audience, right? If you're investing money on behalf of people who are going to be retiring in 40 or 30 years' time, it's your incentive. You don't want to keep churning that capital. If you can find the right investable project, you can match the tenor of that, and you've done a simpler and better job as an investment manager. So I think it requires good long-term projects. That clearly requires the sort of macro stability that you seek. It requires a degree of political consensus. One of the wonderful things about investing in energy security and clean energy is the very strong degree of political consensus. Things like the 2050 net zero bill passed with support from every political party. So even on that long-term time horizon, you haven't got a lot of political risk that could interfere. And don't underestimate, the core natural strengths of the UK, the rule of law, the independent regulatory system. All of these are things that do speak very well to long term. When the government, issues gilts, we have, a gilt curve that stretches out much much longer on average in terms of maturity than most other countries. And there's gilts out there that are 50 years. So there is confidence at investing in the long term. Again, try and strip away some of the barriers. And I think the same actually goes to currency as well, to Rudy's point. You know, if you've got a bunch of sterling liabilities, if you can, while still getting the mathematical diversity, why not be investing in the currency that your liabilities are in?
Actually, I want to say something about the first question. It's lovely to hear Rudy's voice. We worked together a long time ago. It's a really good question, but hence why the British Business Bank is crucial to it, because that is owned 100% by the British taxpayer. So if it wants to be more aspirational and influential in this space, it can make sure that it's only to support more investment in the UK. That part of it is pretty straightforward. On the second one, which I was asked to comment on, it's also a fantastic question. I don't know the answer. I've been in finance 40 odd years. And the reality of the murky world of finance is you got greed there and fear there, and the smartest people are pretty good at dealing with both extremes, and the masses get carried along in the middle. And if you want to change it, you've basically got to change the risk reward. And if you really want people to invest in true long-term things, you've got to make sure that the incentives for them to do so are a lot higher relative to what they perceive as the risk. It's kind of basic, but somehow, and by the way, the UK is far from being particularly guilty of this. We don't, but it's pretty basic stuff. But it's a very good question that needs addressing.
Yeah, I think it's a great question from Mark. And at Phoenix, let me just give you a very brief insight as to how we deal with it. We run a really simple model. We've got a bunch of liabilities to our customers, and we've got a bunch of assets. We need to match those assets to the liabilities. In order to make this real, let me give you a real example. Lord O'Neill volunteered earlier that he was approaching retirement age, so I'm not casting any aspersions on his vintage. For someone like Lord O'Neill, if he were to entrust us with his pension, we would invest it over the very short term. We'd do something sort of 0 to 5 years, because we know Lord O'Neill is going to come knocking on our door looking for his pension, so he can then go and live his life of possibilities. But for you, Mark, and I'm not going to cast aspersion on your vintage either, but I am going to suggest I am going to suggest that you are going to be in the workplace for several years and potentially decades to come. And I think it's really exciting because you're in a really interesting place. But for you, if you were to entrust us with your pension, we would take a multiple decade time horizon on your pensions. How do we invest it? We'd invest it as we did in December last year, just before everyone went away for Christmas. We lent £200 million to a large metropolitan local authority. I can't say who it is, but what I can say is it's outside the London and the southeast. We lent them that money for 30 years. Now I know I'm not going to be at Phoenix in 30 years to get that money back, but that's a really good long-term investment. And a corollary to that is it's not just about lending to large institutions over a long duration. It's really important that we invest in companies now who are creating the technology that's required in the future for us to deliver on our aspirations and carbon net zero. And the UK is in a unique position to do that by harnessing the intellectual property that exists amongst our network of universities. And we lend to universities, and we'd love to lend more to universities into new technologies like that. So I hope I've tried to answer your question by giving you real life examples. If Lord O'Neill does come knocking, we'll absolutely have that cash ready for you, Lord O'Neill, but we'll be investing yours over the long term, Mark.
Thank you. I'm not sure I can add any further insight.
You don't want some money as well, do you?
Definitely. Yeah. But I wonder if I could perhaps rephrase Rudy's question a bit, or perhaps push you, Connor, on Rudy's question, because I think he wasn't actually saying what happens when the funds outgrow the market. I think he was asking, correct me if I'm wrong, what if they don't go into the domestic market in the first place, whereas your answer was about outgrowing. Yeah. So maybe the way to ask the question is, in the Canadian example, were they encouraged to invest in Canada-based assets to start with until they reach a certain size, for
It's a
example?
good question. It really depends on the fund in question. We can get very technical. Some of the funds have an obligation enshrined in law to have due regard for kind of the local economic circumstances of the province in which they created. The classic example of this is the CDPQ in Quebec. Others, so for example, the Canada Pension Plan just achieve a certain amount of returns as required by the Chief Actuary of Canada. But again, they have long invested in Canadian markets. That's where they started, and then they outgrew. But to Mike's point and to Jim's earlier point about the British Business Bank and devolution, they were helped by the fact that the Canadian framework, the North American framework, has very strong local governments that can create investable opportunities, that can encourage these kinds of investment opportunities locally. So I think to your point, yes, there also has to be a demand for this capital locally. And I think one of the open questions going forward is, does the UK have enough of these projects to invest in with this release of capital that will come through Solvency II and these other opportunities? I'm very conscious that we're now over time, and Lord O'Neill has to flee, as does the Minister. So I think on that I'll draw the conversation and the event to a close. Thank you so very much for coming, and thank you for bearing with us for the first few minutes. And best of luck for the evening, and thank you again. And please do take a coffee.